That balance in your bank account, it's deceiving you. The money sitting there right now buys you less than it could yesterday, and by tomorrow it'll buy even less. Want to know the real story behind this? This has nothing to do with free market forces. It's not about capitalism working as intended. It's not even traditional economics in any way you've been taught to understand it. What you're witnessing is the most brilliantly designed system for extracting wealth ever created by mankind, running openly yet somehow staying hidden from 99% of everyday Americans. The U.S. government is drowning in a massive problem, a debt totaling $38 trillion. Imagine earning $50,000 every year and handing over every single cent to taxes. You'd still need 5,180 years just to clear your portion of this debt. And here's the terrifying part, this debt climbs by another $1 trillion every 100 days. If we keep going at this pace, we're looking at $45 trillion by 2030. Fast forward to 2035, and we're staring down over $60 trillion. The cold, hard math tells us one thing: there's absolutely no conventional way to ever repay this debt. But here's the part nobody wants to tell you straight. They already know it's impossible. Every department knows the Treasury, the Federal Reserve, the Congressional Budget Office has run the numbers, and guess what? They've already put their solution into action. But this isn't a solution designed to rescue you. This is their escape plan. The method they're using will slowly drain your wealth every single day for at least the next 10 years, while somehow their own books magically look better and better. You're watching Finance Historian, where I pull back the curtain on the hidden machinery of global finance that operates right under your nose. Before we go further, smash that like button and subscribe if you're ready to learn how money truly operates in this system. Drop a comment telling me where you tuning in from and what percentage of your money sits in cash right now. I am willing to bet that number is going to shift dramatically once you've seen this entire video. Let me reveal something that is going to completely transform how you view every economic move being made today. Back in 1980, the typical American worker could purchase a home for roughly 3 times what they earned annually. These days, that same house costs 8 times their yearly income, but hold-on salaries haven't stayed frozen in place. Actually, median household earnings jumped from $21,000 in 1980 to $74,000 now. That's a massive 252% boost. So what's the problem? Why can't people afford homes anymore? Simple answer: the dollar has been deliberately weakened over time. Something that cost you $1 back in 1980 now rings up at $3.78, and that's just using their official inflation calculations. The actual destruction of your buying power is much, much worse, because they completely changed how they measure inflation starting in 1980, specifically to mask the real damage being done. If we still calculated inflation using the old 1980 method, we see real rates running between 8% and 12% every year instead of the 2% to 4% they report to us. This isn't happening by accident. This is intentional policy. The Federal Reserve operates under what they call a dual mandate: maximize employment and keep prices stable. But here's the secret they won't share with you. There's a third mandate that isn't official but trumps everything else: keep the government from going bankrupt. Everything else comes second to this hidden goal. And the weapon they're using is possibly the most elegant form of robbery ever invented. They're slowly devaluing your savings to pay for government spending. Here's exactly how the machine works. The government requires borrowed money to keep the lights on. They create bonds and put them up for sale. Investors purchase these bonds expecting to earn a profit. But if the government actually had to pay what the market demands in interest rates, the whole system would instantly implode. Paying interest on $38 trillion at a fair market rate of 6% would drain $2.28 trillion every single year. That's almost half of the entire federal budget consumed just servicing debt. Not $1 left for the military, Medicare, Social Security, or any other program before debt payments eat it all. So they simply refuse to pay market rates. Instead, they manipulate the entire financial structure to artificially push interest rates way below where they'd naturally land. And the method they use is so complex and subtle that most trained economists do uneven see it as manipulation. They call it Federal Reserve balance sheet operations, and it represents the biggest financial intervention in all of human history. Back in 2008, the Federal Reserve's balance sheet stood at $800 billion. Right now, it's sitting at $7.8 trillion. Where did that extra $7 trillion materialize from? They conjured it out of thin air digitally. Then they used this newly created money to purchase government bonds and securities backed by mortgage. This achieves two crucial goals at the same time. It gives the government unlimited access to financing for their debt, and it artificially drives down interest rates throughout the whole economy. Whenever the Federal Reserve buys government bonds, they're manufacturing demand that wouldn't naturally exist in a free market. This fake demand forces bond prices upward and interest rates downward because these two always move in opposite directions. The outcome? The government borrows money at 2% to 3% interest instead of the 6% to 8% that actual market forces would require. That's essentially a subsidy worth $1.5 trillion to $2 trillion every year, and it's paid for by every single person holding dollars. But the true brilliance of this scheme isn't just about keeping interest rates low. It's about perfectly coordinating monetary and fiscal policy to create what experts call a fiscal dominance regime. This is the point where monetary policy becomes a servant to the government's financing needs. The Federal Reserve loses the ability to raise interest rates to fight inflation because doing that would immediately bankrupt the government through exploding interest costs. They're completely stuck, and everyone holding dollars is stuck right alongside them. Look at what unfolded in 2022. Inflation exploded to 9%, the worst we'd seen in 4 decades. The Federal Reserve's response was hiking interest rates to 5.5%, marking the fastest rate increase cycle in recorded history. But pay close attention to what they did at the exact same time. They began dumping bonds from their balance sheet to shrink their holdings. Economists call this quantitative tightening. Theoretically, this should have sent interest rates climbing even higher by eliminating the artificial demand the Fed had been creating. But watch what really went down. The Federal Reserve offloaded $1 trillion in bonds, yet the government simultaneously issued $2.5 trillion in fresh debt during that identical time frame. The Fed's reduction got completely swallowed up by new government borrowing. And who stepped up to buy all that debt? Not the open market, that's for sure. Foreign central banks actually reduced what they held by $200 billion. Domestic banks purchased some, but only because regulations forced them to, not because it made good business sense. The real purchasers were pension funds, insurance companies, and money market funds that are legally mandated to hold government securities whether those securities offer decent returns or not. This is what I mean by a captive market. Through banking rules like Basel III, insurance solvency regulations, and pension fund fiduciary requirements, the government has engineered a system where private institutions must purchase government debt or face regulatory punishment that could destroy their business. This represents financial repression in its purest, most refined form, not the dramatic version where governments directly raid bank accounts, the quiet version where they rig the entire financial ecosystem so your money automatically flows into government coffers, invisibly without anyone voting on it or even realizing it's occurring. Let me break down the exact math of how your wealth is being siphoned away. Say you've got $100,000 sitting in savings. You park it in a high-yield savings account that pays 2.5% interest. Sounds pretty reasonable on the surface, except inflation is actually running at 4.5%. Your real return is negative 2%. Each year, your $100,000 loses $2,000 worth of buying power. But what that money can actually purchase equals only $85,400 in current dollar values. You lost $14,600 in genuine wealth, even though your account balance went up on paper. Now take that loss and multiply it across 330 million Americans. The total wealth being transferred from people who save to the government and borrowers runs into multiple trillions annually. This is the method by which $38 trillion in debt vanishes without ever being paid back. Not through declaring bankruptcy. Not through economic expansion. Through the deliberate, systematic obliteration of what your money can buy. But the nightmare gets worse because the system is engineered to speed up over time. The more debt piles up on the government's books, the more desperately they need inflation to shrink the real weight of that burden. The more inflation they unleash, the more interest rates must be forced down to keep debt payments affordable. The more rates get suppressed, the more deeply negative the real returns become for anyone trying to save money. It's a feedback loop that reinforces itself and can only resolve in one of two ways. Either the dollar loses its status as the world's reserve currency and everything collapses, or they successfully use inflation to erase the debt over the next 10 to 15 years and hit the reset button at a lower debt-to-GDP ratio. The Federal Reserve is gambling everything on the second option, and history actually backs up their bet. Between 1945 and 1970, the United States slashed debt from 106% of GDP down to just 37% of GDP, mainly through financial repression. They capped interest rates, let inflation run hotter than those rates, and forced financial institutions to hold government bonds. What resulted was a 25-year wealth extraction from savers to the government that wiped out two-thirds of the debt load without paying back a single dollar of principal. They're running the exact same playbook again. Same fundamental strategy. Massively larger scale, far more sophisticated in execution. And this time around, they've got tools that didn't exist back in 1945, digital currency frameworks, offering complete visibility into every single transaction, regulatory frameworks that have captured every major financial institution, coordination with foreign central banks through organizations like the Bank for International Settlements, ensuring simultaneous policy rollouts across multiple economies. The roadmap has already been drawn up. The Congressional Budget Office forecasts that under current policies, debt to GDP will top out around 180% by 2050, then start dropping. But that decline won't come from actually paying down debt. It'll come from nominal GDP growth driven by inflation growing faster than debt accumulation. Translation, they're replanning to use inflation to erase $20 trillion to $30 trillion in real debt burden over the next quarter century. Here's the mathematical breakdown of how it works. If nominal GDP expands at 5% per year, let's say 3% real growth plus 2% official inflation, but actually more like 2% real growth plus 3% hidden inflation, the economy doubles every 14 years. A $27 trillion GDP in 2024 becomes $54 trillion by 2038. If debt only climbs to $60 trillion during that same stretch, the debt-to-GDP ratio improves from 132% down to 111%. The government appears more financially stable even though absolute debt increased by $22 trillion. But the real magic happens through inflation destroying what that debt can actually buy. That's $60 trillion in 2038. After 14 years of 3% actual inflation, has the same purchasing power as only $39 trillion today. The government owes $60 trillion on paper, but merely $39 trillion in real purchasing power terms. They've erased $21 trillion in actual debt burden without defaulting or making one extra payment. And who foots the bill for this trick? Every single person holding dollars. Every savings account sitting in a bank. Every bond in every portfolio. Every pension fund counting on future payments. Every insurance policy promising benefits. Every person retired on fixed income. The wealth doesn't just evaporate into nothing. It moves from people who save their money to the institution that spent recklessly, from private citizens to government ledgers, from productive economic sectors to wasteful government spending. This explains why housing prices never stop climbing. Why stock markets keep smashing records despite economic fundamentals that don't support the valuations. Why cryptocurrencies pull in billions despite creating nothing of tangible value. People are running away from the dollar as fast as they can. Not into foreign currencies because every major economy is playing the same game, into hard assets that hold value, real estate. Stocks, gold, literally anything that is under promise of future dollars that will be worth less than today's dollars. The Federal Reserve can't admit this publicly because doing so would trigger the exact crisis they desperately trying to prevent. If people truly grasp that the dollar is being intentionally devalued to wipe out government debt, they'd dump dollars instantly. The currency would crater. Hyperinflation would become a self-fulfilling prophecy. Their strategy only functions if it stays below the radar of public consciousness. So they use carefully crafted language designed to confuse and obscure. They say quantitative easing instead of printing money out of nowhere. They call it accommodative monetary policy instead of artificially suppressing interest rates. They label it flexible average inflation targeting instead of admitting they're deliberately letting inflation run wild. They talk about price stability. Even while prices surge 20% to 30% across every major category of household spending, the technical jargon creates psychological distance between their policies and the real-world consequences. It makes you believe they responsibly managing the economy when the truth is they managing a debt crisis by using your wealth as their solution. Consider the recent shifts in their approach. The Federal Reserve kept insisting inflation was temporary throughout all of 2021 while it rocketed from 2% up to 7%. They didn't wait until inflation hit 9% before finally raising rates significantly. Then they stopped the rate increases at 5.5%, even though inflation remained stubbornly above 3%. Why stop there? Because pushing rates any higher would have sent government interest payments screaming past $1 trillion annually, consuming a full 25% of the entire federal budget. They're imprisoned by their own debt mountain. They can't raise rates high enough to genuinely crush inflation without bankrupting the government in the process. They can't lower rates without making inflation accelerate even faster. So they're attempting to balance on an impossible tightrope. Keep rates elevated enough to look like they're serious about fighting inflation. Keep them depressed enough that debt payments remain bearable. Allow just enough inflation to quietly eat away at debt burdens. Suppress just enough inflation to avoid completely losing public trust. This is the razor's edge they're walking. The only way it succeeds is if the majority of people do uncomprehend what is happening until it is already finished. By the time the average American wakes up and realizes their savings lost 30% to 40% of what they could buy, the government's debt burden will have shrunk by comparable amounts. Mission accomplished, wealth successfully transferred. Problem solved for them, on to the next crisis. The international aspect makes this even more brutal and devastating. Foreign central banks and sovereign wealth funds are sitting on approximately $7.6 trillion worth of U.S. Treasury securities. When the dollar weakens and inflation chips away at bond values, those losses hit foreign holders the hardest. China is holding $850 billion. Japan is holding $1.1 trillion. These nations are essentially subsidizing U.S. debt reduction by eating losses on their Treasury investments. But they cut and just dump those holdings without setting off a crisis that would damage them even worse than holding onto depreciating assets. If China suddenly sold off $850 billion in treasuries rapidly, it would absolutely crash the bond market, send interest rates skyrocketing, and potentially ignite a global financial meltdown. They're caught in a classic prisoner's dilemma situation. They know full well they're hemorrhaging money, but selling would trigger even more catastrophic losses. So they hold tight and watch their wealth steadily transfer to the U.S. government quarter after quarter, year after year, powerless to stop it. This is financial warfare dressed up to look like normal market activity. The United States exports inflation to its trading partners while simultaneously reducing its own debt burden through currency manipulation tactics. Other countries face a brutal choice: either accept currency losses by continuing to hold dollars, or allow their own currencies to weaken to stay competitive in exports, which imports inflation and crushes their own citizens' standards of living. The final stage of this plan is already becoming visible if you know what signs to look for. Central bank digital currencies are being developed at the same time across all major economies. These aren't simply technological improvements, they're control systems. With CBDCs, governments gain absolute visibility into every single transaction anyone makes. They gain the power to implement negative interest rates directly on digital currency holdings. They can automatically extract wealth taxes. They can shut down transactions they disapprove of. They can force people to spend during economic slowdowns by programming currency to expire if it is not used. This represents the ultimate evolution of financial repression taken to its extreme conclusion. Not just negative real returns on your savings, but the actual ability to confiscate wealth directly through programmable, controllable currency. The technology already exists and works. The frameworks are actively being constructed right now. The public messaging emphasizes convenience and security while the real purpose stays carefully hidden. How you respond to this information will determine whether you survive this wealth transfer or become one of its countless victims. Keeping cash guarantees you'll lose 3% to 5% of your purchasing power every single year. Holding bonds at today's yields guarantees negative real returns stretching into the foreseeable future. The system is deliberately designed to force you into risky assets, because those represent the only places where you might possibly keep pace with inflation. But even risky assets carry serious dangers in this environment we're in. Stock market valuations are at historic peaks because everyone's desperately fleeing the dollar. Price-to-earnings ratios that would normally scream overvaluation become accepted as the new normal when your only alternative is guaranteed purchasing power destruction. Real estate prices that appear completely unsustainable just keep climbing higher because real estate is a hard asset, denominated in dollars that actually benefits from dollar devaluation. The survival strategy for individuals requires fully understanding this mechanism and positioning yourself accordingly. Focus on hard assets that cannot be inflated into worthlessness. Make productive investments that generate genuine economic value. Diversify internationally to reduce your dependence on any single currency. Take on debt strategically in situations where inflation makes that debt cheaper to service over time. Basically anything except holding promises of future dollar payments. Because those promises are being methodically devalued every single day. Every bond you own, every savings account balance, every money market fund, every pension you're counting on, every insurance benefit promised to you. They're all denominated in future dollars that will purchase far less than today's dollars can. And the mechanism guaranteeing that devaluation is operating right this second in real time with mathematical precision and certainty. That $38 trillion doesn't just disappear into thin air, it gets transferred. From your ability to buy things to the government's ability to stay solvent. From privately held wealth to publicly held debt reduction. From people who saved and planned responsibly to institutions that spent recklessly and irresponsibly. And the beautiful part of this whole system from the government's point of view is that by the time you finally understand what happened to you, it'll already be completely finished. The debt-to-GDP ratio will have improved on paper. Government officials will claim credit for responsible fiscal management. Academic economists will publish papers celebrating successful debt reduction strategies. And every single person who held dollars through this entire transition will be quietly, invisibly, mathematically poorer than before. Not poor enough to take to the streets, not poor enough to spark revolution, just poor enough that the wealth transfer accomplished exactly what it was designed to do without, triggering the kind of crisis that would expose this mechanism to real public scrutiny and outrage. This represents the most sophisticated theft in all of human history, executed in broad daylight for everyone to see. Documented in official Federal Reserve papers and publications, modeled extensively by government agencies, yet completely invisible to the ordinary people who are bearing its entire cost. Your purchasing power is being used as collateral in a debt liquidation process that spans multiple decades. The only real question is whether you recognize what is happening in time to actually protect yourself and your family. Or whether you'll end up as one of millions of people who sits around wondering in 2035 why everything costs 3 times as much while their savings barely budged. The mechanism is already active and running. The transfer is happening right now as you watch this. The mathematics are absolutely inexorable and unavoidable. What you choose to do with this information will determine which side of this massive wealth transfer you end up on. Choose wisely and choose quickly. The clock is already ticking down.